Right. Uh, Good morning to you all. Today we will discuss a new subject area in the accounting theory. That is generally accepted accounting principles. So when we practice accounting and we are following some accepted principles. Everybody, all professional accountants follow there are some certain principles. So even in US, Sri Lanka, India, so wherever they are using this principle. For example, dual accounting concept, long dual concept, and going concern concept, accrual basis, and historical cost accounting. These kind of things are uh, practiced by uh, all all accountants. So this is called generally accepted accounting principles. Here, generally accepted accounting principles, as I told you that all accountants in the world are come to a common agreement. For example, dual dual aspect of accounting and double entry system and cash basis on accrual basis accounting and going concern entity concept, like that. So accounting concept and accounting principles. SEC, Securities and Exchange Commission, the stock market. So the regulating body of stock market. So yeah, there are you can find there are companies are listed there. For Colombo Stock Exchange, in Sri Lankan context, Colombo Stock Exchange is governed by Securities and Exchange Commission and Financial Accounting and Standard Board set generally accepted accounting principles. So generally accepted accounting principle accounting standards. Here here expenses, here it says that, but expenses recognition principles, some sort of accrual concept, revenue recognition principles, cost principle, full disclosure principle, conservatism, going concern assumptions, time period, every 12 months they are reporting income, and monetary measurement concept there are, right? So these are normally we use in accounting when we are preparing financial statement. Accounting is a language of business, which means that accounting is a media of communications. The investors, the shareholders, are the real owners of the business companies, but actually the companies are run by management, the team of management or board of directors, and every year and the management, the board of shareholders, the board of directors should report their financial performance and activities, financial transactions to the shareholders, the owners. For that they are using accounting, financial statement. The financial statement is the means of communications. The financial statement, they are using a language. There are some commands, there are some sort of scripts and amounts. So this can be considered, these financial statements, the content of financial statements are prepared based on accounting principles. Here, that's why we call accounting is the language of business, which means that accounting is a media of communication. So to take the language, convey the same meaning to all people. All people mean what? The users. Accountants all over the world have developed certain rules, procedures, and conventions which are often called as generally accepted accounting principles. Right? So the language should be understandable by everybody. Therefore, this language should be common. For example, we use English. If we uh, cross the border of Sri Lanka, we try to use English rather than other languages, other local languages, because it's a common language, international language. So English language can be understandable by everybody. So therefore we use like accounting to convey the financial communications to the shareholders and other users. Accounting is a language that be accepted by everybody. So generally accepted accounting principles represent the consensus view by profession of good accounting practices and procedures. Thus, accounting principles may be defined. How we can define accounting principles? First, as those rules of actions or conduct. So, when we are doing accounting, when we are practicing accounting, we follow some certain rules of actions, which are adopted by accountants universally, worldwide, while recording the transaction. The dual entry concept, accrual basis, going concern. So these are what, when we record the financial transaction, we keep it in mind, we assume that. So by taking that assumption, we record the financial transactions. So as those rules of actions or conduct which are derived from experience and practices, and when they prove useful, they are adapted as principle of accounting. So these are practiced by a long period and practiced by many accountants. So therefore we also grabbed that experience from their genetics. For example, if you are obtain a chance to get an experience in an audit firm, you observe what your seniors, what your preceders, and you carry that things. You absorb knowledge, you grab knowledge from the experience, and utter broadly the body principle, the body of accounting for financial transactions, underlying preparation of set of financial statements, and it is used broadly, not by few people, few accountants. It is practiced by many people, and that principles are govern accounting, right? So not only you, for example, for a particular transaction, sales, cash sales for 10,000, how you record, the same way will be followed by anyone else in your position. Recording of accounting transactions is not differ person to person or accountant to account. GAAP are, however, not a rigid one. It's not a complex. It's not a hard thing. So they are subject to change. It can be changeable. They have evolved in order to deal with practical problems, problems experienced by change. They are subject to change. So some principles may not applicable certain areas, so they can be changeable, right? So they have evolved. It has some sort of growth stages, and it's not invented at all. So it's little by little. So it has been developed, evolved in order to deal with practical problems experienced by the preparer. So who are the preparer? Who is the preparer of accounting statements? face some sort of, regardless of situations. We have to apply all the times. We have to apply dual concept accounting, accrual basis, going concern, separate entity concept, prudence, substance over form. So these are no choice. You have no choice for that. You have to follow that. But different way of doing depreciations. So that sort of things are choices. You can use FIFO, weighted average method, LIFO. These are choices. So these choices are not principles. So they are policies. They present the best possible guidelines based on reasons, right? So the GAAP, the accounting principles, generally accepted accounting principles, they represent the best possible guidelines based on reasons, observations, and have been developed by accountants to enhance the usefulness of accounting data in ever-changing society. So it is not a one-time invention. Right? It has been developed for a long period. It has been observed for many times. For each principles, it has a reason. It has a logic. So these kind of principles try to enhance the usefulness of accounting data. So you can understand the financial statement prepared by any accountants in any countries, because you know the accounting principles, and the preparers knows the accounting principles. So the user, the preparer, and the user, the accountants, management, government, everybody knows the accountant. The same, everybody knows the principles, and therefore it is easy to understand, right? It has enhanced the value for the accounting data. So it is a process of evaluation and change. It is developed little by little and change whenever it is not applicable in a certain situation. It can be changed. So general acceptance of accounting principle usually depends on how well it meets the following criteria. Relevance. What do you mean by relevance? Usefulness to the stakeholders. Objectivity. So not subject to personal bias. So relevant. So when the financial information should give relevant information to the shareholders. Objectivity, the answer, right? Whenever asked question, the answer should not depends on the person who asked the questions, or it's not depend on who answered the questions, right? So whoever asked the question, whoever answered the question, it cannot be changed. Objectivity. It's not a subject to the personal bias. It is person to person, never change. No. Mr. X asked how much sales? 10,000. Y asked how much sales? 10,000. Mr. Z asked how much sales? 10,000. Right? So same thing. Relevance. Relevant mean what? So it should provide information relevant, right? For example, Mr. X asked company profitability of A, but he responds as profitability of company B. Is that relevant? No. We are talking about company A, but he give information about company B. It's not relevant. And we are asking about company profitability this year, but he give the statement, give the information about previous year. No, it's not relevant. So it should be usefulness to the shareholders. And feasibility. So not all the information can be shareable. Not all information can be disclosable. So they have used some sort of strategies, costing methods, and price fixing method. So these are the company secrets. All these such informations can be disclosed, can be shown, can be disseminated to everybody. Right? So feasibility, applicability without undue complexities and cost. To get information, to disclose information or obtain information, we should not spend much time. Basic concepts underlying historical cost accounting. You know what is historical cost accounting? Historical cost accounting. So historical cost accounting postulates are generally defined as a basic assumptions that can be verified. So normally in accounting we apply historical accounting concept. For example, if you purchase a machinery for 10,000, so you should record as 10,000. But due to the inflation and some sort of things, now the value of the machinery is 15,000 or 17,000 or 20,000, like that. But even in this situation, you have to record as 10,000 because you have purchased the 10,000. That's called historical cost. You are implementing historical cost. So there are basic assumptions concerning the business environment. Almost every business should apply the historical cost accounting. So material purchased for 10 rupees and you have to record is 10 rupees, but in the market the material 20 rupees, 25 rupees, 50 rupees, 100 rupees, the market price. However, you purchased 10 rupees, then you have to record as 10 rupees. It serves as a foundation for inference. So you can inference mean what? You can read and you can interpret by yourself in inference. Principles, on the other hand, are general approaches utilized in recognition and measurement of accounting events. So not all accounting events are recordable. Right? Not all the things are recordable. Not all the events are recordable. So employees or welfare function, a facilitation ceremony or opening ceremony. Do accountants report that event? Company got award. Company has get an award. Is it account information? No. And the value of management, the value of employees, do we recognize? No. All the things are not recorded in the transaction, recording in the accounting, because so it has to utilize some certain recognition criteria to recognize an asset, a resource as an asset. It should meet some sort of criteria. Here, so benefit and significance. It is ease of understanding of financial statement, ease of comparability of financial statement, simplify reporting, common format, communication clarity, reduces chances of cheat, interfirm comparison, finding improvement areas. And if all accountants use the same foundations, same principles, this kind of benefits can be achievable. Otherwise, everybody prepares financial statements according understandable. So accounting principle, for example, accounting for sincerity, accounting principle for sincerity, principles of consistency, principle of regularity, principle of permanence of method, principle of non-compensation, prudence, periodicity, good faith, utmost good faith. So these are the accounting principles. We have some sort of accounting assumptions that are going concern, time period 12 months, no, on the date, year end date, asset, right, and accounting entry, monetary units. So these are the accounting assumptions. Here these are accounting principles. Here basic concept underlying historical cost accounting. When we look at the historical cost accounting, so we can have two broad areas. So postulates and principles. So postulates sometimes we call what? Assumptions, right? Postulates is kind of assumptions, and so that are going concern the entity will run alive for foreseeable future, right? The long term, the company is not closed down today, tomorrow, next month or next year. The company will be forever, will be in the business forever, time period. So the company, the entity should report the financial transactions and statements every 12 months. Accounting entity concept, owner is different from the owner is separate from the business is separate entity, and the owner is separate entity, accounting entity. Monetary units. In accounting, we record all the transaction, all the events which are measurable in terms of money. So these are accounting postulates. Right. Sorry for that. There are some interruption. Network interruption. Sorry for that. Right. Postulates are the assumptions where we can find going concern. The business entity will run the business, will alive for a long period. And the time period, so the entity should report the financial statements in every 12 months. Accounting entity concept mean the business is separate from its owner, and monetary unit means the transaction or events that can be measurable in terms of rupees or dollar or whatsoever currency, that only can be reportable. So these are the postulates, accounting assumptions. In addition to the accounting assumption, we have principles, accounting principles. So we can divide this accounting principle into two. First one is input oriented principles and output oriented principles. Then this year also, there's no changes every year. There's consistency of policy and uniformity. So these are things we are going to cover. So basic concepts underlying historical cost accounting. So these are the things we have to discuss in detail. We'll see first the basic concept, postulates. In other words, we can call it as the first and utmost thing is the going concern concept. Going concern. So it's very familiar to you. Simply we can say the firm, the business entity will run its business, will exist forever. They not have an intention to close down the business in this month or next year or so. So it assumes that a business unit has a reasonable expectation of continuing business at a profit for indefinite period of time. So when we record the transaction or present the balance statement, so preparer, the accountant, should assume that the firm will be exist infinitively and make profits. So it should be keep in the mind of the accountants. A business unit is considered to be a going concern and not a gone concern, right? Not a past one. Going, it's going, right? Not a gone. Going concerns. It will be alive, continue its businesses for a foreseeable future. And here, right, impact of going concern, concept of accounting. Impact. What are the impact in that assumptions? First, credit transactions are recognized and recorded in the accounts on the assumption that business will continue in the future to settle on those dues. So that's why they are allowing credit purchases. In our journey, we can settle the money or we can collect the money from the purchase or from the sales. And fixed assets. The assets can be usable for a long period. Run current assets. So fixed assets are recorded at original cost, historical cost, and depreciated over time, 10 years period. So if the assets useful life is 10, it's kind of damaging the asset value in the books. So no need to show the assets at fair value, no need value in the market, and emphasis on determination of net income rather than on the valuation of assets. Net income.